Hey everyone, let's dive right into this, and welcome to a brand new explainer on the GAAP Advisors Ind AS Clinic YouTube channel. If you're a focused learner looking to really master the intricacies of accounting standards, you are in the exact right place. Today we're looking at a fascinating case study that explores that very fine line between adopting a new accounting policy and, well, correcting a past mistake. We're going to break down the complex rules around borrowing costs so you get a crystal clear understanding of the correct accounting treatment. Now, right before we open up our patient's file today, I just need to cover our standard clinical disclaimer. The views expressed herein are the personal views of the author and are not binding on the audience. The audience is requested to seek the help of an expert before any action or refraining from any action based on the views discussed herein. It's always crucial to get specific professional advice for your unique reporting situations. Here is our quick roadmap for today's explainer. We'll start with the intake, review the symptoms, form a differential diagnosis, check the lab results, issue a prescription, and wrap up with some preventative care.
Section 1. The intake, sourcing the issue.
So, the specific diagnostic case we are unpacking today comes straight from the 231st edition of the GAAP Advisors Task Weekly newsletter. This is authored by CA Manish C. Iyer, director at GAAP Advisors, and it's published right over on LinkedIn. With 232 incredible editions published to date, today's case is just a perfect snapshot of the high-level insights you can find there. Moving to Section 2, the symptoms, a shift in borrowing costs. Okay, take a look at the financial behavior our patient, is exhibiting here. Previously, they expensed millions of Indian rupees in borrowing costs directly to their profit and loss statement. But suddenly, they want to change course. Now they're looking to capitalize those exact same Indian rupee costs into the construction of their qualifying assets. Essentially, they are adding those costs directly to the balance sheet value of the assets themselves. That is a massive behavioral shift. Section 3, the differential diagnosis. Classifying the change. As diligent auditors, we have to ask a really crucial question right off the bat. Are they simply choosing to adopt a new, perhaps better accounting policy, or are they quietly fixing a past mistake? Figuring this out completely dictates how the company has to report this change in their financials. Let's look at Section 4, the lab results, consulting Ind AS 23 and Ind AS 8. Let's run the numbers through the lab. Under Ind AS 23, the core principle is that borrowing costs directly attributable to a qualifying asset absolutely must be capitalized. It's a strict requirement. So what does that mean? It means their old method of expensing those Indian rupees was fundamentally flawed from the very start. They weren't just using an acceptable alternative. They were outright violating the standard. Which brings us to the second piece of the puzzle. Paragraph 5 of Ind AS 8 gives us the formal definition of prior period errors. It explicitly tells us that errors include mistakes made in applying accounting policies from ignoring reliable information. Since the company failed to apply the mandatory capitalization rule in Ind AS 23, they made a mistake in applying an accounting policy. So, by definition, their past practice wasn't a choice, it was an error. Section 5. The prescription, retrospective treatment. The lab results are conclusive, so here's the prescribed treatment. Paragraph 42 of Ind AS 8 mandates a strict retrospective correction. You cannot just slap a Band-Aid on this going forward. Step 1, you have to carefully restate the comparative amounts for the prior periods where the error actually occurred. And Step 2, if the error happened before the earliest prior period presented, you've got to restate the opening balances. Basically, you have to reflect those capitalized Indian rupee costs as if the mistake literally never happened in the first place. Finally, Section 6, preventative care, equipping auditors. We all know fixing an error retrospectively is incredibly painful. It means digging through old records and recalculating balances, which is exactly why preventative care is an absolute must. The diagnostic issue and response we've discussed today was actually pulled straight from the massive issue repository over at GAPadvisors.com. This site hosts over 4,500 issues and detailed responses on Ind AS and Indian GAAP. Any person can register for free and submit issues for a detailed response delivered straight to the inbox of the email you register with the site. This is a brilliant tool, especially useful for auditors who need to rigorously document exactly how they addressed any tricky issue relating to the application of Ind AS. We want to sincerely thank you for your time today. If you found this clinic session helpful, please be sure to like this explainer, add your comments or questions below, and definitely subscribe to the GAAP Advisors Ind AS Clinic channel if you're not already subscribed. It really helps us keep creating this kind of content for you. Let's wrap up with one final thought for you to take back to your desk. When you see a company suddenly change how they account for something, look a little closer. Are they genuinely innovating and adopting a valid new policy, or are they just finally getting around to curing an old error? Knowing the difference is the hallmark of an exceptional finance professional. Thanks for joining us, and we'll catch you in the next explainer.